All right, now we're going to enter information into the T12 tab. So the T12 is the trailing 12 financials of the property that you get from the broker, which is going to help you kind of see how the property's been performing and maybe where there's some red flags or opportunities. So this is an example of the T12 for this property, and its period is basically May 2024, from June 2023 to May 2024. So we're going to go ahead and enter the date of when we received this. So this is as of date of 5/31/2024, and then it says it will recalculate so June all the way out to May. All right. So the next step is then to just make sure that all the columns, there's no additional columns or anything else. But what you can do is just simply just highlight from the title all the way out to the end of May. So we're going to highlight all this. I'm going to leave out the totals column, but I'm going to copy everything in here. Okay, go ahead and copy, and then, whoops, that's not what, sorry. And see where it says T12 line item. Instead of doing the, you could simply do this, do the values number, and it will format it to whatever the format is here. But instead of doing that, I actually like to do it this way so that I can actually see the breakdown, how they had it. And just easier for me to read and where the summary lines are. So tenant net rent, this is basically a summary of right here. So this shows 173, which matches 160 or 173,160. Okay. So then everything's totaled up over here in this column. So let me explain these columns a little bit more for you. So once you enter in all this information in here, then it's going to calculate what your T12 is. So basically the summary of the last 12 months. So if I highlight all that, total that up, that's 2.092 million, which matches 2.092 million right here. This is the last 6 months of performance. Okay. This is the last 3 months and the last month of performance. Okay, so this is just looking at basically the last month of rent. Okay, 182. So then in the following columns, these are blank right now, but we'll soon be filling out some information. But it will calculate the annualized figures. So the last T12, the T6, but annualize that, the T3, last 3 months, and it will annualize that out, or the last month, and then multiply that by basically 12 months to annualize that out. Okay, so what we now need to do is, over here is basically our category column. So if you have this drop-down menu here, you can start selecting what each of these line items are. So we've got gross potential rent right here. So let's go ahead and highlight that. Boom, gross potential rent. And now that gross potential rent, so for the T12, for example, let me do this to the whole sheet. There we go. Gross potential rent over the last 12 months. You can see here, this is the summary. Gross potential rent, 2.2 million. 2.2 million is right here, 2.2. 1.1 for the last 6 months, 565 or 188. Okay, this is all great. And again, what I was saying about the annualized figures, so the T12, of course, the annualized is the same. T6, we're going to annualize this. So it's basically this number times 2, this number times 4, and this number times 12. Okay, to get that. The reason that we do that is we want to see, is there growth actually happening within this property? So over the last 12 months, we see 2.2 million. And if you look at the T6, it's a little bit of an increase, which is great. Again, a little bit of an increase again, 2.26 versus 2.30. And then if we annualize just the last month and figure, okay, this last month's performance, we're going to carry that next forward to the, for the next year. And that's 2.2, which is 2.26, which is greater than the annual T12. Okay. So then it kind of breaks it down over here, the gross potential rents. I have a column here for just like, what are we going to use for our actual? Are we going to use the T12? We're going to use the T6? We're going to use the T1? And it's really up to you. So, for income, I usually look at the T3 expenses or income, sorry, the T3 income. But for expenses, I usually use the T12. So the T12, usually carries annual costs such as like insurance or taxes. That may be a lump sum in certain months and not others. So you want to get the full picture by just looking at the T12, and I'll explain that more in a bit. And then it shows what the gross rent per unit is based on the gross potential rent, 1366, and the gross potential rents. So it's always good to look back at this number. 1366 is the gross rents for the last T12. If we go back to our unit mix, they're showing 1388. So, our in-place rents, should be around 1388. But on the T12, it's showing 1366. And that's fine because there's been some vacancies and I made some adjustments in mine. So these are closely aligned. But if we use the T1, which is closer to the rent roll of 1388, right? 1388 in place rents. And if we use the T1 annualized, we're at 1386. We're only $2 off. So that's great. We're pretty aligned there. Okay. So just so you know, these are the drop-down menu categories all right here. You could change these. Don't delete them because that's what the drop-down menus is relying on. But you could change these if some of these don't necessarily apply to you. There's some, you could add in some additional fill-in items or what. But that's where the drop-down menu categories are. So you go through and, you start labeling these. So vacancy loss, for example, vacancy loss. Okay. And then at the top here, as you start filling in these categories, it automatically calculates what your vacancy loss is. So let's look at that over the last 12 months. So we have 3.3, 2.7, 3.8. They had pretty high vacancy or higher vacancy this month, during these months. And then it came back down to basically great levels. What happened on this property, and this is a red flag for you. Like, what happened? Figure this out. Like, ask the broker, what happened in October and November? Well, the fact is, on this particular property, it was already under contract and fell out of contract twice. And during that time, there has been some turmoil within the staffing. And some of the staff actually left. And there was nobody to assist with new tenants coming in or leases expiring. And so, the vacancy started to increase until they brought in somebody that was permanent and they could get more stability on the property and gain more control. So that's the story that happened right there. So these are the things that you want to start looking at is, why is that increasing? And why is it maybe not coming down? So, is there greater vacancies in the area? Are there development projects going on that are absorbing the tenants? So these numbers up here help you look at the bigger picture. This is why I like looking at the T12 in detail instead of just plugging in numbers from the broker. Tenant leasing concessions. So that's concessions here. Bad debt. We got, not concessions, bad debt. And then employee concessions. Okay. So now they're all filled out here and they don't do loss to lease. I normally don't do loss to lease. I look at loss to lease if it's on their T12, but I don't necessarily believe in the loss to lease thing. So that's a topic for another day. So then you go through here and you start categorizing all these other activities. So pet rent, other fees. You don't have to get it bang on for what these are. Just getting it close, right? So fee income, blah blah blah. So you keep going all the way down here, filling it out as much as possible, and to make it convenient for payroll, for example. Instead of doing that one by one for each one of these, you could just come down here to the bottom, which is a summary of everything above it, and then just entering in payroll. Okay, so payroll 216,000, which is the sum of all these categories, 216,000. And whoop, I did not mean to do that. Cancel. And so 216 should be the number on my T12 here under payroll. Here's payroll right here, 216 under the T12. So if we look at the T12 versus the T1, wow, their payroll really went high. So that's another red flag. Why did their payroll go high? Maybe because they had the leasing turnover, the going out of contract and falling out of contract twice, and having to bring in new leasing managers. They probably had to pay somebody a little bit more, so that somebody that has experience to gain control of this property, and pay them a little bit more. So I'm going to go ahead and fill out the rest of this information in here, and we'll see how that plays out here. So I'm going to pause the video here in a second, but I'm just going to do a couple here for you. So landscaping, not payroll again, sorry. Landscaping, and you could even type it in. So utilities, maintenance, repairs and maintenance. Okay, so I'm going to pause the video here. I'm going to fill out everything, and then we're going to look at the details. Okay, so I have gone through and categorized everything within the T12 here. So broke down the rental income, utility income, other income, and then to get the net operating income. So the net operating income 2.4. So you want to, after you go through this, you want to just double check everything lines up. So 2.4 million for the T12. So 2.4. Yep. So the effective gross income being at 2.4, perfect. And then as we come down through the expenses, I got payroll, landscaping, utilities. So I broke it out with electricity, water, sewer, and other utilities, utility billing services. So that's just part of the general utilities. Maintenance. There's a lot of different maintenance items in there, and you can go dive deep into each one of these and see what they all are and break it out even further if you wanted to. But I just categorize it as repairs and maintenance at the end. Turnover costs, marketing, promotions. So I call it advertising and promotion. Administrative costs, all that rolled into one. Management fees, insurance, real estate taxes, and then coming down to the net operating income. Everything below the line, meaning below the net operating income, I don't really pay attention to in the initial round. It does include like debt services, other expenses, capital expenses, repairs and maintenance, serious repairs that they've done to the property that you could dive into and see what they've worked on. And so if we come down here to the net operating income, NOI is 896 and 1.56 should be the totals. So come back up, just double check here. So expenses 1.56 is your total expenses, and your NOI at 896. Perfect. So everything matches up, and it matches the T12. Everything is good, so it reconciles. And so here's the annualized figures. So again, the T12, T6, which is the last trailing 6 times 2 trailing 6 months times 2, last trailing 3 months times 4, and the last month times 12. And you just kind of look at trends, just seeing how the income might be growing, which it is. That's nice to see. And then as far as the expenses, actually the expenses increase. So, you want to start asking questions. Why is that? Why are we seeing higher expenses? But again, like I was saying earlier, if you look at the last month and annualize that over, you're probably not capturing everything, because some payments are, taxes or other utility or insurance might be paid in different chunks throughout the year, and it might not add up. So it's, you could dive into it and take a look. And then so over here, some other things that I look at. So again, looking at the gross rent per month on an annual basis and just seeing how that's performing. And then as far as RUBS, so this is RUBS is the utility billing services. And right now they're charging about $90,000 for RUBS, and they're only collecting about 50% of the actual utilities. So if you were to actually look at this formula, so it's 90,000 divided by the actual utilities that are in place. We're going to add this one here. So you might have to play around with it and just make sure that you're capturing everything. And so look at, 49%, really still about the 50%. And, there's an opportunity right there. You can be at 80% or even up to 100% getting that money back if you are doing a true RUBS program. Now this, this only works probably in certain states or provinces or jurisdictions. So check with your property manager as to, what is common and what can be achieved in your particular market. And so, you kind of go down the line, just seeing, what other income items there are. There's laundry income, pet income. There's a lot of pets that are there. Internet income is a big thing. And that was actually something that was advertised within the offering memorandum. Okay, and then as far as, just looking down through the expenses, making sure that all looks good. And then coming down here to the end, looking at your expense ratio is 63%. Now for this property in particular, and in this market, we should be somewhere between 45% and 50% operating expense ratio. And so right there, that's telling me that there's some opportunities. Their expenses are quite high. We're looking at, a total expense per unit per year of $11,500. And if you remember, I keep track of, expenses per unit in different markets and different vintage types and so on. And we should be somewhere, say, on average, around 8,000 per unit per month. And we're currently at 11,000. So right there, that's also telling me something is too high. So this is a chance to really dive into it with the property management company, and figure out what's really going on here. Okay. So everything that's in here, so I say use for actual. So if you look at these numbers, 2.09, 2.42, and 1.5. Now, if you go back to the inputs tab, you can see here, so we're going to be showcasing basically the T12, right? So the T12, you change that and it changes the income and the expenses items here. So 2.2 and your effective gross income 2.4. So we should be at 2.4, 2.465, perfect, 2.465. And then our expenses, 1.569, 1.569, perfect. And then our NOI of 896, and we're at 896, perfect. Everything matches up, reconciles for on this sheet, and you can see their operating expense ratio is at 64. Now, because we entered in all these, this is the reason why I like doing the T12 is because you don't have to sit here and punch a bunch of numbers. You could go through and actually categorize everything, and then it brings it into this inputs tab, so that it saves you time from doing a lot of data entry or possible errors, and you're scratching your head. Where did I screw up? And it's to me, it's a lot faster and a lot more effective. You could also look for opportunities such as the rubs feature, for example, and you get to see more of like the story of what's happening month over month. So all these are broken down as an expense per unit here, and so you can see repairs and maintenance. They're at 1246 when we should be somewhere around 400. Contracts. So this is something to look into. Maybe repairs and maintenance and contracts are actually rolled in together. So if I summarize these two, it should be $800 per unit. It's closer to the 1200, and that's probably what it is. I could break down the repairs and maintenance a little bit more for like into contracts. Turnover costs, they're a little high for what we should be seeing. Landscaping, this is something that you could look into too. And as far as like my history here, landscaping is sometimes included in contract services, but every property is unique. And so they might have more trees on a specific property, or different gardens or lakes, or like, it's Phoenix and like desert. And so there is no landscaping. And so, that could change. And then payroll 1,500 versus around 1,300. I'm going to probably bump that up. I would bump that up to probably around 1,600 for this type of property. Advertising, they're a little high. General administrative, really high. Total utilities. And so as far as utilities, that's a fixed cost, and you really can't change the utilities unless you go in and you have a plan to use low flow toilets, or kind of optimize the building a little bit more, make it more green, so to speak. So, but for now, we're not really able to change that. So I'm gonna make it equal to what you see here. Property management fee, 3% is about right. And then insurance. This is where you need to get basically a number from a broker, an insurance broker, to get updated insurance. And you can see that they're currently paying $3,200 a unit, which is really high for this property in this market. And I would start to dig into why is that. And quite frankly, we have dug into this one, and they are paying extremely high insurance compared to what we should be paying, which is closer to about $1,800 for this property. So $1,800 is what I'm going to put in here. In real estate taxes, they're currently paying $1,613. And you can go in and do a full-on tax analysis, which I do have actually in my full underwriting model. But for now, what we could do is just simply take what's there. And it really depends on the market you're in too, and how they assess taxes. Some markets, they reassess your taxes every 2 years, every 4 years. Sometimes it's reassessed upon sale. And so you really talk to your broker and find out how real estate taxes are calculated. Sometimes they include a breakdown within the offering memorandum. And so let's just take a look here at what their taxes are for security, replacement costs, controllable. Non-controllable. Insurance, sorry, there we go. It's at the top. I'm used to seeing it at the bottom. And so they're saying insurance is at $1,200 and real estate taxes at $2,347. Wow, that's really high compared to what I had here. So dig into that one. So $2,347. Okay. Now that puts our operating expense ratio closer, and it's not such a dramatic drop. And you want to make sure that this is tapered down nicely instead of a drastic, sharp drop, which that helped there. Okay, so now we kind of go through and fine tune everything. We got 3% closing costs, which is about typical, somewhere between 2.5% and 3% of the purchase price. Acquisition fee, that's about standard 2% of the purchase price. And then loan fee, let's just check everything is looking good here for 70%. I'm going to just change this to 6%. I'm going to do 1.5%. Oh, so there is saying, we might be a little high. So if I change that to 68, 67%, all right, that's a little bit better. All right. And then this is typically 75% or 80%. All right, so this is more probably realistic. 30 years, 6.5 annual interest rate. I think we're closer now to 6%, which is it's great. The 10-year Treasury has been coming down, and we're still at over 20%. So if we do another data, what if we do maybe increase our purchase price a little bit, 0.2, by changing this. All right, so now we're at 14.76. So probably a little off, from the broker's guidance, is 67%. That is pretty far off. And at this point, I would start discussing details with your property management company and the broker. So where does this land us? So this is the investment summary now. You could put in a little bit of a description here on about the property, what the opportunity is. Up here, it's all taken in the details about the property, the address, number of units, where it was built, and the market. Seller's information, which is all right here, acquisition summary, disposition summary, the value add details, project level returns. Again, you're looking at unlevered IRR and levered IRR of 20%. Sources and uses, unit mix, performance metrics. So break-even occupancy in year one is at 78%. That's great. Shows that you can basically have up to 22% vacancy, which you don't want to have, but there's a lot of buffer there. So, and some nice cash flow snapshots here, and you can kind of dig into the bar graphs and what these trend lines are showing. So that's it. That's the quick back of the envelope underwriting spreadsheet. And I'm here anytime. If you have any questions, I'll put my contact information in the step-by-step here for you. So we broke it down. We talked about the rent roll, the T12, and all these different inputs. The next step is for you to basically start talking to the property manager and broker, and see how far you're off, and what you could probably improve on your underwriting. Maybe bring up this asking, or the percentage of asking, bringing that closer together, or as it happens, that the broker can be way off on their original whisper price, and the brokers need to hear that. The brokers need to know what market is telling them. We are the market. We are the ones that are actually dictating what the true value of these properties are. So don't be shy to tell a broker, hey, I'm 67%. In order to make this deal work, I am 67% of your asking price. And I can't go any higher unless we dive into it and figure out where I might be wrong, what you see that I don't see. Maybe there's additional income. Oh, then that's a good point. Additional income right here. So initially I plugged in $1,800 a unit, which is what the broker said. But if you look at all the income right here, that's totaling up to $2,700. So let's take it like for like. So 1370, 714, and 663. Okay, now that really helped. Look at that. So that was something that I was missing. So this is why it's helpful to start having these conversations and looking, having somebody review your underwriting and go through it and explain it to them, like where the opportunities are, and what your prices are. All right. So now we're at 16.4. So now you're at 75% of asking price. Bang on. So a little inside information. We got this under contract at 16.8. So, and when the whisper price was around 22 million originally. So we are quite excited about this property. And it's good to see just, quickly going through this valuation, and just a very high level. You could do this within 30 minutes and come to an offer that's pretty damn close to what our offer was. So, and what it got under contract on. So, anyways, hope you enjoyed that. Feel free to reach out to me anytime, and looking forward to hearing your feedback. Thank you.